Okay, so let's be real. The AI hype it's absolutely everywhere, right? It feels like all anyone can talk about are the software models and of course, the chip giants like Nvidia. But what if the biggest part of this story isn't about code or silicon at all? Today, we're going to dig way deeper and uncover the massive, kind of hidden physical world that this entire AI revolution is built on. So, if you feel like you missed the boat on the whole GPU rally, don't sweat it. You might have just been looking at the wrong part of the supply chain. The real choke points, and maybe the most lasting opportunities, they're not in the software. They're in the physical world. We're talking about electrical transformers, heavy-duty cooling systems, and the unbelievable amount of raw power needed to bring AI to life. All right, so here's how we're going to break this all down. First, we'll look at the new AI gold rush that's happening right now. Then, we're going to bust two huge myths about where the actual value is. After that, we'll uncover the real bottleneck that's threatening this whole boom. And we'll wrap it all up with a classic picks and shovels playbook for this new digital frontier. Let's set the scene. We are in a full-blown modern-day gold rush. The investor hype is just completely off the charts. I mean, Nvidia recently hit a mind-blowing $3.34 trillion market cap, briefly making it the most valuable company on the planet. And that insane demand for their chips is what's fueling this entire AI boom. Right now, all eyes are on a handful of tech giants, the Magnificent Seven, and the cool AI models they're creating. But here's the thing. Is that really the full picture? What if the most important part of this entire story isn't happening on our screens? What if it's actually buried in the ground, humming away inside power plants and running through miles and miles of fiber optic cables? And that question leads us right into our first huge myth, this idea that AI is somehow weightless. We think of it as living in the cloud, like it's just some lines of code, some magical weightless brain floating around in the digital ether. Well, that could not be further from the truth. The reality is that AI is fundamentally a business of atoms. Every single query, every image you generate, every task an AI does, it has a direct physical cost that consumes real-world resources. Think about it. Every time you ask a chatbot a question, somewhere a physical server spins up, a cooling fan kicks into high gear, and real electricity gets burned. And this physical foundation, it's not just one giant building somewhere. It's this really complex three-tiered system. You've got the massive cloud facilities for the brute force, super energy-hungry job of training the models in the first place. Then you have on-premise data centers for what's called inference. That's basically just running the models to get you answers. And finally, you've got edge devices, like your phone or robots in a factory, that need AI processing instantly without having to talk to the cloud. Building all this out requires something called physical capital deepening. And that's just a fancy way of saying you have to pour billions and billions of dollars into stuff you can actually touch. We're talking specialized liquid cooling systems, endless fiber optics, and buying up huge pieces of land that have access to tons of water and power. And this is where it gets really interesting for the people building the stuff. They measure efficiency with a metric called PUE, or power usage effectiveness. A perfect score is 1.0, meaning every watt goes to computing. But most data centers are nowhere near that. They burn a ton of energy just on cooling, which makes the companies providing that tech absolutely essential. So, if AI has this massive physical cost, who's actually footing the bill? Well, that leads us right into our second big myth, the idea that all the money is being made by the AI software companies themselves. The story here is, well, it's a lot more complicated and frankly, a little wild. So here's the major disconnect. On one hand, you have these soaring valuations. But on the other, many of these famous AI startups are burning through cash at a rate that is just breathtaking. And here's the brutal truth. A huge number of investors are chasing these software darlings, but many of them have no clear path to actually making a profit. I mean, just look at OpenAI. They're aiming for $13 billion in revenue for 2025. Sounds amazing, right? The problem? Their projected losses for that same year are a staggering $8.5 billion. Reports say they're actually losing money even on their most expensive subscriptions because the cost of running the computations is just that astronomical. So how is this even possible? How do they stay afloat? Well, a big part of it is this fascinating, kind of weird mechanism called circular financing. Let me walk you through it. A tech giant, say Microsoft, invests billions in a company like OpenAI. Then OpenAI turns right around and uses that exact same money to buy cloud computing power from, you guessed it, Microsoft. It makes it look like revenue is exploding, but it can really hide the true economic health of the company. It's almost like paying your customers to buy your own stuff. All right, so this all leads us to the absolute heart of the matter. If the AI models are burning through cash and the physical build-out is this enormous, what's the one thing that could bring this entire boom to a screeching halt? It isn't a lack of money. It's not even a shortage of chips. It's power. Plain and simple. So let's just ask it directly. What is the single biggest threat to this whole thing? The answer is almost shockingly simple. It's having enough electricity. All these data centers, all these expensive GPUs, they're just expensive paperweights if you can't plug them into the wall. And when you look at the numbers, they are just staggering. Projections show that AI data centers are going to need 156 gigawatts of power by 2030. Now, to put that into perspective, OpenAI by itself is planning to build out up to 26 gigawatts of capacity. 1 gigawatt is what a single large nuclear power plant produces. So one company needs the power of 26 nuclear power plants. Let that sink in. This creates this massive risk of what's called stranded capital. Billions spent on chips that literally can't be turned on. And this chart, this one chart, really tells the entire story. On one side, you have AI's demand for power just exploding, set to soar by 2030. And on the other, you have the growth of the US power grid, which has been basically flat for years. You have a freight train of exponential demand heading straight for a brick wall of linear supply. That is the real bottleneck. And look, there's no magic wand here. You can't just order more power from Amazon. Let's just take nuclear power, for example, which is great for the kind of constant energy data centers crave. Just getting the application reviewed and approved can take 5 years. 5 years! Then actually building the plant can easily take another 5 or more. So you're looking at a 10-year timeline minimum to solve a problem that is growing exponentially right now. Okay, so this sounds like a huge problem, right? But whenever you have a huge problem or a huge constraint, you also have a huge opportunity. If you understand these physical bottlenecks, it opens up a totally different way to look at the AI revolution. It's a strategy known as the picks and shovels playbook. You've probably heard this before, but it's never been more true. Back in the California gold rush, most of the prospectors who were digging for gold actually went broke. The real, lasting fortunes were made by the people who sold the miners the stuff they needed. The picks, the shovels, the denim jeans. They made money no matter who actually struck gold. And the exact same logic applies here today. So who are the modern-day pick and shovel sellers in this AI gold rush? Well, we're talking about the companies building the physical backbone. This includes the power infrastructure firms and the regulated utilities, many of whom have super stable 20-year government-backed contracts to sell power. It's the thermal management specialists like Vertiv creating those vital cooling systems. It's networking companies like Arista that are connecting all these chips together. And it's the physical deployment companies like EMCOR that are actually out there building and wiring these massive data centers. And what this quote really gets at is the massive shift that's happening right now in the market. The whole investment story is changing. We're moving out of that first build-out phase where basically any company with AI in its name just soared, and we're moving into the bottlenecks phase. Now, the real, tangible value is in solving these critical physical problems. Which really leaves us with one final, big question to chew on. As these AI models get smarter and smarter and capable of doing just incredible things, where will the smartest money actually be placed? Will it be on the constantly changing, cash-burning software? Or will it be on the boring but absolutely essential power socket that it has to plug into?